So if you open your trading app on like a random Tuesday, the S&P 500 looks less like a financial metric and more like, I don't know, an electrocardiogram of someone having a full-blown panic attack.
Oh, absolutely. It's just a mess of lines.
Right. You see these jagged spikes, sudden plummets, and just chaotic squiggly lines that seem completely detached from whatever is actually happening in the real economy.
Yeah, and we are constantly told that the market is rational, that good news creates a green arrow and bad news creates a red one.
Exactly. But anyone who has ever stared at a live ticker knows that the day-to-day reality feels like absolute visual noise. It's just terrifying trial and error.
Which is incredibly frustrating if you're trying to find any sort of logic in it. It really feels like the financial world is reacting to ghosts half the time.
It totally does.
But, well, this brings us to the core of what we're unpacking today. What if that sheer chaos isn't noise at all? What if it's actually a strict, definable mathematical code?
And that is the premise of a really fascinating econometric study we're diving into by economist Fabio de Jesus Suarez Agudelo.
It's a brilliant piece of research.
It really is. The mission of this deep dive is to fundamentally change how you look at those squiggly lines. We're going to explore how analyzing the S&P 500 across different time frames, using tools like polynomial regressions and frequency distributions, can actually replace all that terrifying guessing with a rigorous scientific method.
Yeah, we're essentially moving from a bird's eye view of global capital straight down into a highly specific 6-degree mathematical roller coaster.
And don't worry, you won't need a PhD in math to get the aha moments here. But to even begin to understand the microscopic daily panic at the stock market, we kind of have to establish a baseline first, right?
Right, exactly. Because the mathematical model in this study doesn't treat the market as one massive monolithic blob.
Thank goodness, because it's definitely not.
No, not at all. It dissects it by time frame.
Yeah.
So it starts with the long-term reality, utilizing a mathematical tool called a polynomial regression to smooth out, like, decades of historical volatility.
Okay, let's unpack this regression concept because I really like to visualize things physically.
Sure, that usually helps.
So imagine laying a stiff, heavy steel beam straight across a deeply rocky, uneven hiking trail.
Okay, I'm picturing it.
That steel beam is the long-term polynomial regression. It doesn't dip into every pothole or bend over every boulder on the trail. It just rests on the highest points, pointing in a clear, sustained upward trajectory.
That is a great analogy. That physical constraint is exactly how the math operates on a macro scale.
So it's just ignoring the short-term bumps.
Yes, it irons out the dot-com bubble, the 2008 financial crisis, sudden global pandemics, all of it. It reveals the underlying structural trend of the economy.
Which is incredibly useful.
It is. And the study pairs this with a frequency distribution histogram, which basically maps out how much time the price spends at certain levels.
And for the long term, that histogram is incredibly wide, right?
Exactly. It's wide because it captures massive, prolonged periods of economic expansion and capital accumulation.
Right, because the S&P 500 isn't just an abstract number. I mean, it's a grouping of the 500 largest companies in the United States.
From slow, defensive utility companies all the way to bleeding-edge tech giants.
Exactly. So that steel beam pointing upward is acting as a direct barometer of human productivity, corporate innovation, and just overall wealth growth.
Yeah, and because of that underlying capital accumulation, the S&P 500 becomes the cornerstone for measuring the global equity risk premium.
The ultimate benchmark.
Precisely.
Yeah.
The quantitative metrics derived from this long-term upward bias, specifically the Sharpe ratio, serve as the baseline for global finance.
I want to pause on the Sharpe ratio for you listening because, it sounds like heavy finance jargon, but it's actually just a measure of risk versus reward.
That's a perfect way to put it.
It basically calculates how extra profit you're getting in exchange for the stomach-churning volatility you have to endure.
Exactly. And the S&P 500's ratio is the center of gravity. I mean, every other equity asset on the planet is evaluated against that specific baseline.
Wait, literally every asset?
Yeah, pretty much. Whether an institution is looking at emerging markets in Southeast Asia, global commodity futures, or fixed income bonds, they're comparing it to the S&P 500.
Oh, wow.
Yeah, if a foreign asset can't offer a better mathematical return for the risk than the S&P 500, global capital simply flows back into the U.S. market.
Okay, I mean, a beautiful upward slope is great if I'm holding an index fund for 40 years. But major institutions aren't just sitting on their hands for 4 decades.
No, definitely not.
How do they handle the actual economic cycles we live through? Like when the Federal Reserve suddenly hikes interest rates or inflation spikes out of nowhere?
Well, they just swap out the tool. As the time frame narrows to the medium term, the mathematical regression adapts.
How so?
If the long-term model is that stiff steel beam you mentioned, the medium-term model introduces a bit of flex.
Oh,
The polynomial regression starts to capture narrower economic fluctuations, and the frequency histogram concentrates into intermediate ranges.
so the math is literally mapping out the actual business cycles.
Yeah.
The expansion and contraction of credit, corporate earning seasons, the whole macroeconomic push and pull.
It maps the exact transition phases. In the study, the math highlights changes in concavity, which are essentially inflection points.
Okay, what does an inflection point look like in this context?
It's where the curve objectively stops bending upwards and begins bending downwards. By formally identifying these points, an institutional portfolio manager doesn't have to just rely on a gut feeling that the economy is slowing down.
They have actual data.
Exactly. The regression model provides a deterministic quantitative trigger showing that the rate of growth is mathematically decelerating.
Which brings us to the absolute most chaotic part of the journey, the short-term view.
The daily noise.
Right. So if the long term is a steady steel beam, the short term is like throwing a highly flexible heavy steel chain over those rocks. The chain hugs every single jagged edge, every crack, every pebble.
That's exactly it, because the short term operates on entirely different mathematical rules. That smooth frequency histogram we talked about, it
It
shatters.
just breaks apart.
Yeah, it becomes highly fragmented because the market is reacting constantly to immediate technical changes, sudden geopolitical events, rapid shifts in earnings expectations.
Right, like a news story breaks about a supply chain disruption, and instantly the price violently adjusts to reflect that new reality.
This is textbook adaptive market efficiency. The price is continuously and rapidly discounting new information.
It's just fascinating.
And to capture this level of extreme volatility, the study employs a high-order mathematical model, specifically a sixth-order polynomial regression.
Okay, I have to push back here.
Go for it.
In the data science world, using a sixth-degree polynomial to map a messy, chaotic data set is usually considered a cardinal sin
Totally.
because it causes a massive problem called overfitting. And for anyone listening who isn't familiar, overfitting is when your mathematical formula tries so hard to touch every single random data point that it essentially memorizes the past chaos instead of finding the true underlying trend.
It misses the forest for the trees.
Exactly. A model that overfits usually completely destroys your ability to predict the future. So why is an econometric study utilizing it intentionally?
What's fascinating here is that the study openly acknowledges the danger of overfitting.
Oh, they know it's a risk.
They absolutely do. By using a sixth-degree polynomial, it intentionally sacrifices out-of-sample predictive power. You absolutely cannot use this specific formula to guess what the market will do 3 years from now.
Okay, so what is the point then?
The goal here isn't long-term prediction. It's microscopic descriptive accuracy.
So it's about diagnosing the present moment with extreme precision.
Yes, exactly. For tactical analysts and high-frequency trading algorithms, the overarching decade-long trend is completely useless on a Tuesday afternoon.
Right, they don't care about 10 years from now.
They need to identify local highs, local lows, and sudden inflection points in real time. And a sixth-degree polynomial has exactly enough mathematical flexibility to capture multiple complex peaks and troughs.
How many peaks are we talking?
Up to 5 or 6 local extremes. It fits the chaotic, short-term price movements, like a custom-made glove.
Okay, to prove this out, the study takes this abstract theory of a sixth-degree polynomial and uses it to map a real-world, highly specific short-term market cycle.
Yes, it gets very granular.
It breaks down an actual sinusoidal curve like a wave in the market into 3 distinct phases. Let's look at how the math actually translates into human trading behavior.
Let's do it. So phase 1 is the contraction and bottom phase.
The dreaded drop.
Right. The market experiences an aggressive downward slope. The price is falling, and retail sentiment is usually plunging right alongside it.
People are panicking.
Exactly. But then a specific mathematical event occurs. The first derivative vanishes.
Wait, it vanishes?
Yeah, the formula's rate of change literally hits 0, marking what the study calls the first valley.
Here's where it gets really interesting. Think about being on a roller coaster for a second.
Oh, I like this.
You dive down a massive drop, and right at the very bottom of the dip, just before the coaster starts shooting back up, there is a microscopic split second of 0 gravity.
Yes.
Your downward momentum completely stops, but your upward momentum hasn't engaged yet. Your speed in either direction is just 0.
That is a brilliant way to picture it. That is the first derivative vanishing.
Wow.
And in the real world of institutional trading, that moment of zero gravity is the ultimate trigger.
Because the math said so.
Exactly. While everyday investors are panic selling because the chart looks terrifying, the institutional algorithms see the math hit zero.
The bleeding has mathematically stopped.
Yes. And this triggers automated buy orders, causing the price to experience a short-term rebound with a positive concavity. In other words, the curve bends upwards.
The coaster starts shooting up.
It shoots up until it hits a crucial inflection point. At this exact moment, the speed of the price rising hits its absolute maximum.
Which launches us into phase two, right? The expansion and ceiling phase.
You got it.
We pass that maximum speed inflection point, and we see what the study calls bullish deceleration.
Right.
The market is still going up, but the rate of the rise is just getting tired.
Yeah, and if we look at the human mechanics causing that bullish deceleration, it makes perfect sense.
Because people want their money.
Exactly. The institutions that bought the dip at the first valley are now looking at significant short-term gains. So they start taking profits.
Naturally.
They sell off portions of their positions, which creates overhead supply. This selling pressure fights against the upward momentum, slowing the ascent until the market reaches the absolute top.
Another moment of zero gravity, the crest of the wave.
Exactly. The rate of change is zero again. And from there, bearish forces take total control.
It's all downhill from there.
The profit-taking turns into an aggressive sell-off. The price is dragged down with negative acceleration, dropping faster and faster until it reaches its most violent downward speed at the next bearish inflection point.
Which brings us to the final part of the cycle, phase 3, exhaustion and final support. So the price is falling rapidly, but eventually the downward curve begins to lose its steam.
Yes, there's another change in concavity as the bearish momentum just exhausts itself, culminating in the second valley.
But the study points out a highly counterintuitive detail here, doesn't it?
It does.
This second valley hits a significantly lower low than the first valley.
The math actually projects a deeper drop. And again, this aligns perfectly with market psychology.
Because that lower low triggers a massive cascade of stop-loss orders.
Exactly.
When everyday traders buy into the market, they often set automatic triggers to sell if the price drops below the previous valley, just to protect
A
themselves.
safety net.
Right. So when the price breaks past that first valley's floor, all those stop-losses trigger at once, causing a localized panic.
And it creates a huge flush of liquidity. Technical analysts watching the chart see a lower low and immediately assume the market is entering a long-term crash.
But they're wrong.
They are. Because the sixth-degree polynomial model anticipates this exact structural flush. It knows that the exhaustion of those panic sellers forms the true bottom.
That is wild.
Right after that deeper valley, the polynomial registers a clear, short-term, bullish reversal, projecting growth through the end of the recorded cycle. The math successfully maps the human panic.
It literally turns the sheer terror of a market dip into predictable geometry.
It really does.
But this naturally leads us to a massive structural problem. I mean, if we have a mathematical map of human greed and panic, why can't we just use this exact sixth-degree formula to predict the S&P 500 indefinitely? We'd all be billionaires.
Well, because every mathematical model has an edge to its map.
The danger zone.
Exactly. The study provides a critical warning regarding the danger zone of higher-order polynomials. We established earlier that they are intentionally overfitted to perfectly trace 5 or 6 specific extremes in a localized window.
Right, the custom-made glove.
But if you try to push a sixth-degree formula past its designated time frame, the math violently breaks down.
Because an equation with a variable raised to the sixth power is going to exponentially explode the moment it steps outside its fitted boundaries.
Yeah.
The lines on the graph will just shoot straight up or straight down into impossible infinity.
The model becomes entirely unstable. So for institutions looking to project beyond that immediate short-term cycle, this study recommends completely abandoning the pure polynomial model.
What do they use instead?
You have to transition to a harmonic model, specifically Fourier or sinusoidal models.
Okay, which are essentially the exact same mathematical models used to analyze sound waves or light frequencies, right?
That's right.
So instead of trying to force a stiff mathematical curve to hug random jagged rocks, a Fourier model breaks the complex chaos down into a series of simple, repeating pendulums.
Beautifully said.
It finds rhythms that can continue indefinitely without exploding into infinity.
It creates a sustainable projection.
So what does this all mean? Like, what does this multi-layered, highly technical econometric breakdown mean for the real world?
Well, it comes down to where global capital actually lives.
Hmm.
When we analyze those frequency histograms and see the sheer concentration of trading volume, it confirms something huge,
What's that?
that the U.S. stock market, and the S&P 500 in particular, is the primary destination for the world's wealth.
I mean, this is where sovereign wealth funds operate. It's where pension savings, 401ks, ETFs, and mutual funds are parked. The scale is almost unfathomable.
And the massive institutions managing that wealth are not operating on intuition.
They aren't watching Jim Cramer.
No, they aren't staring at a news ticker and guessing how the market might react. They are utilizing these exact statistical summaries, metrics of central tendency, dispersion, and regression coefficients
It's all math.
entirely. They identify the exact mathematical duration of upward and downward phases. They pinpoint the acceleration of the trend at those specific inflection points to calibrate optimal entry points, exit points, and hedging strategies.
It entirely removes human emotion from the equation. And, understanding that this quantitative framework is operating behind the scenes fundamentally levels the playing field for you listening. It changes your entire psychological posture.
It really does.
When a sudden violent drop happens in the market, you stop seeing a reason to panic and you start looking for the inflection point. You start looking for that zero gravity moment where the derivative vanishes.
It is a masterclass in seeing the hidden structural scaffolding beneath the daily noise.
It absolutely is. And if you are someone who thrives on the deep mechanics and wants to explore the underlying formulas yourself, or, if you're part of an institution looking to request a specialized econometric study, the author of the research, economist Fabio de Suarez Agudelo, can be contacted directly.
Well, that's great.
Yeah, his email is fs1950@gmail.com. Again, that's fs1950@gmail.com. It is incredibly rewarding to pull back the curtain on how multi-temporal analysis actually dictates global capital.
It is. But, if we connect all this back to the broader ecosystem, it leaves us with a rather profound paradox to consider.
Ooh, I love a good paradox.
Well, we established earlier that the short-term market is governed by adaptive market efficiency. The concept that the price of an asset instantly moves to discount new information in the real world.
Right. A news story breaks, the price adjusts.
But if every major institutional algorithm managing trillions of dollars is universally adopting these exact same polynomial and harmonic models to dictate their trading,
Right.
do the mathematical models themselves eventually cease to be just measuring tools?
Oh, wow.
Do they become the new information the market is reacting to?
That is wild. So if everyone's math triggers a massive sell-off at the exact same mathematical inflection point, the market doesn't crash because of a real-world news event.
Oh.
It crashes because the math dictated it.
It raises a fundamental question about the future of finance. Are these econometric models simply mapping the geography of the market, or are they slowly trapping the entire global economy in an endless, self-fulfilling algorithmic loop?
That is a staggering thought to leave on. So the next time you open up your trading app and find yourself staring at those chaotic, squiggly lines, remember that you aren't just looking at random noise. You are looking at the footprint of a deeply complex, entirely emotionless mathematical machine. You just needed the decoder ring to see the gears turning.